Hello, this is Pat Walker at MissionWinners.com, and this is an answer to a question from NGHIA. And NGHIA, if I am mispronouncing your name, please accept my apologies. I am not trying to be rude. That is one thing I don't do. But I do want to answer your question. He asked this question. This is for everybody. What is your trading strategy for a long-term portfolio? Is buy and hold still relevant for long-term anymore? He said, I'm looking to grow my portfolio and I don't want to contribute extra money every month. Is swing trade the best for both long and short term? And it's a series of wonderful questions. Do I believe in buy and hold? Yes, but I must tell you, we must have very stringent rules on buy and hold. And part of those rules are buy and hold. You may have to be, at times, willing to sell it. You can't argue with any of these stocks because they can get killed. Everybody says Netflix is a great company. Well, we have to watch the action very closely. So here's a couple of rules for you. This is what I would focus on. If you want to strive for longer term, and I love longer term, I love letting the stuff work for me. Here's what I found. Rules. Focus on leading stocks in the leading groups, top 20 or 30 groups. Do not do any low price stocks. Focus on companies that have a really unique niche. That's why I love the Max List stocks. They are franchise companies. Buy them focusing on weekly charts, not daily, weekly charts. Watch the action on the 10-week moving average line, which is the 50-day, or the 8-week exponential moving average line. Okay? Buy breaking out of long, clean, simple bases. Buy with a volume surge. Buy when the market is in an uptrend. And be willing on every one that you do to limit your losses. You could say, well, Pat, I've followed all those rules. I'll just own it. You can't do that. We have to be willing to sell. So you can say, well, then buy and hold doesn't work? No, buy and hold can work. But when you buy something, you still have to monitor it, regardless of what it is. I'll show you something. I'm pulling up a chart on Netflix, and everybody says, oh, Netflix is wonderful. Look at the move on the weekly this thing has made. This is just beautiful. Well, that's great. But if you bought it, that's investing through the rear view mirror. If you had this cup formation and you bought it right here on a weekly cup, right here, say at around 132, and watched it drop all the way down to $84, you can say, well, it came back. At the time that's happening, you don't know that. So look for longer bases on the weekly and buy them. But I do have to share this with you. This was back in 2011. The individual that bought the stock lifting through this shorter shelf here, which is something you shouldn't do on a weekly, but if you had bought it at $39 to $40, you watch that stock in several months fall all the way down to $9. You can say, well, it came back. You don't know that at the time. So I stress, look for longer weekly bases in good quality companies. Buy them breaking out of clean patterns, long patterns, with a volume surge. But I say this again, you must always be willing to limit your losses. Because if you're wrong just a couple of times, you could say you're buy and hold, you can destroy yourself financially. It pushes away in price, just you can let it work, but still monitor it. Why? I will show you why. I will do Amazon, a premier company. Look at this beautiful trend. Everything is great. Well, right here, if you bought it up high, you're down about 140 points. Right here in 2008. 2008. You said, well, you bought it out of this flat base right here at $88 a share and watched it drop all the way down to 40. You can say, well, it came back. When it's doing that, You don't know the future. So it's important. Look for weekly, long basis, breakouts in good markets in long basis. Let them work for you. And I will look for, again, franchise companies that you can monitor, that you know they're the best in their field, and let them work. Last point I'm going to make, and I'm going to throw you a curveball. If you want to have a good return without micromanaging it too much, another way to go, and it's really simple. QLD, NASDAQ 100 ETF. It's not going to be as explosive as an individual stock, but it's also going to be less volatile. QLD and SSO is another way to go to participate in the markets. I hope that helps you, and I thank you so much for asking the question. And again, if I mispronounce your name, please accept my apologies. Thank you very much. And again, I hope that what we're doing here helps you make your account grow over time. I've been doing this for 32 years, and I pour my heart into it. So thank you very much. And again, we'd love to work for you.